Warren Buffett, the Oracle of Omaha, the most successful investor in the world. He currently has over $140 billion in wealth. But did you know that a huge portion of this massive wealth comes from just a few companies? Yes, you heard that right. Warren Buffett's entire portfolio has hundreds of companies, but 80% of his wealth comes from only 5 to 6 companies. And he believes that if you can pick the right companies, just 3 stocks are enough to make you rich for a lifetime. Did the title make your eyebrows rise? Are you thinking, how is this possible? We've all heard it growing up. Diversify. Don't put all your eggs in one basket. But Buffett says diversification is protection against ignorance. If you know what you're doing, you don't need diversification. In this video, I'll explain in detail Warren Buffett's philosophy that helped him become a billionaire with just a few stocks, why he believes 3 stocks are enough, how to choose those 3 stocks, and why most people remain poor even after buying 20 stocks. We'll discuss everything. Watch till the end, because in the last 5 minutes, I'll tell you the names of the 3 sectors from which you can choose your 3 stocks. And if you can pick those stocks correctly, 20 years from now, you'll be financially independent. So let's get started. Part 1. The diversification myth. We've been hearing since childhood, don't put all your eggs in one basket. We follow the same rule in the stock market. Financial advisors say, spread your investments across 20-30 companies. Mutual fund companies say, our fund has shares of 50-60 companies. It's safe. But did Warren Buffett follow this path? No. Buffett's Berkshire Hathaway portfolio has about 50 companies, but 80% of his wealth comes from only 5 companies: Apple, Bank of America, American Express, Coca-Cola, Chevron. Over 75% of his investments are in these 5 companies, meaning Buffett doesn't diversify. He concentrates. Once an investor asked Buffett, I have $100. How many companies should I invest in? Buffett replied, if you can identify good companies, invest in just one. If you can't, buy an index fund. What's the point? Buffett believes that if you truly know a company deeply, if you're confident that this company will do well for the next 20 years, then you should invest all your money in that one company. Because if you invest in 20 companies, you actually don't know any of them well. Peter Lynch, another legendary investor, once said, he who doesn't know 10 companies won't profit even by investing in 1,000 companies, and he who knows 5 companies well can become rich by investing in just those 5. Now, the question is diversification bad? No, not at all. Diversification is safety. But this safety comes at a price. That price is you won't get very high returns. You'll get 10-12% returns from index funds, but not 20-25%. And those who want to become rich, 10-12% returns aren't enough. They need 20-25% returns. And to get that, you need to take some risk. And taking that risk means you concentrate on a few companies. Buffett said, broad diversification is only protection against ignorance. If you know what you're doing, 6 companies are enough for you. 6 companies. Buffett himself has concentrated on 5 companies, and these 5 companies have made him a billionaire. Now think, if you have $10,000, you divide it among 20 companies, $500 in each. One company goes up 200%. Your profit is only $1,000. No impact on the entire portfolio. On the other hand, if you invest your $10,000 in just 3 companies, $3,300 each. Now, if one company goes up 200%, your profit is $6,600. The entire portfolio changes. This is the power of concentration. This is why 3 stocks are enough to make you rich. Part 2, why only 3 stocks? Now the question is, why 3 stocks? Not 5, not 10, exactly 3. Why? According to Buffett's philosophy, there's logic behind 3 stocks. It's neither too many nor too few. First reason, focus. If you work with 3 stocks, you can know each company deeply. You can read their annual reports. You can learn about their competitors. You can know their management team. You can use their products. You can fully understand their business. And if you work with 20 stocks, you won't know any company well. Is it possible to read 20 annual reports in a week? No. Is it possible to keep track of 20 companies? No. So you actually won't know where your money is. Second reason, confidence. When you fully understand a company, you'll have confidence in that company. Even if the share price drops, you won't be afraid, because you know this company is good. The price will go up again. Market noise won't affect you. When you invest in 20 companies every day, some company will have bad news. One's price will drop, another's price will drop. You'll be stressed, and from stress, you'll make wrong decisions. Third reason, return potential. Suppose you bought 3 stocks. One of them goes up 10 times, and 2 stocks perform poorly. Even then, your portfolio will give good returns, because the effect of the 10x gain will impact the entire portfolio. On the other hand, if one stock out of 20 goes up 10 times, but the other 19 perform poorly, the impact won't be felt on the entire portfolio. The 10x stock will be killed by the effect of the bad stocks. Buffett once calculated that only 20 decisions in Berkshire Hathaway's entire history have brought 90% of their wealth. Only 20 decisions. The thousands of other decisions didn't contribute much. That's why he says, you'll get the chance to make 20 important decisions in life. Make them right. There's another reason for choosing 3 stocks. That's risk management. Putting all money in one stock is too risky, because if that one company performs poorly, you lose everything. With 2 stocks, risk still exists, but with 3 stocks, risk decreases significantly. If you take 3 stocks from different sectors, risk decreases even more. For example, take 1 tech company, 1 consumer goods company, and 1 healthcare company. Now, if the tech sector performs poorly, if the other 2 sectors do well, the portfolio will survive. And if the economy performs poorly, consumer goods companies usually survive. People don't stop drinking Coke, so the portfolio remains protected. This is the magic of 3 stocks. Not too many, not too few. Exactly 3. Part 3. Buffett's 3 stocks. Now we'll learn which 3 stocks Buffett himself likes the most. Actually, Berkshire Hathaway's portfolio has many stocks, but we'll talk about his 3 biggest investments. From these, we'll learn the criteria for choosing good stocks. Stock Trust 1, Apple. Buffett's biggest investment is Apple, about $160 billion, more than 40% of his entire portfolio. The funny thing is, Buffett himself doesn't use an iPhone. He uses an old phone. Then why did he invest so much in Apple? Even though Buffett doesn't understand Apple's product, he understands Apple's business model. He understands that Apple has an ecosystem. Once people buy an Apple product, they can't leave. They'll buy an iPhone, then an Apple Watch, then a MacBook, then an iPad. This ecosystem generates billions of dollars in revenue annually. The bigger thing is Apple's customers are very loyal. Among the world's most loyal customers, Apple's customers are top tier. They'll buy new iPhones every time, whatever the price. This customer loyalty gives Apple a competitive advantage. Another strength of Apple is that they have enormous cash, over $100 billion in cash. With this cash, they can develop new products, buy new companies, or buy back shares. Buffett likes share buybacks because they increase the value of his shares. Buffett sees Apple as a consumer products company, not a tech company, and Buffett understands consumer products companies very well. Stock number 2, Coca-Cola. Buffett's second biggest investment is Coca-Cola. He first started buying Coca-Cola shares in 1988. The price per share was about $5 then. Today's price is about $60. Not only has the share price increased, he's also received dividends all these years. Now he gets about $700 million in dividends every year from Coca-Cola. Why does Buffett like Coca-Cola? Because it's a very simple business. People drink Coke all over the world. This trend will continue. Coca-Cola's brand value is so high that no one can easily take their place. Coca-Cola's business model is very strong. They sell concentrate to bottling companies. Those companies make and sell Coke. Coca-Cola itself doesn't have many assets, so their costs are low and profits are high. Another thing is, Coca-Cola pays dividends, increases dividends every year. Buffett likes dividends because with dividends, he can buy more shares. The magic of compounding works. Buffett once said, "If I didn't have Coca-Cola, I might drink something else. But for investment, there are very few companies like Coca-Cola." Stock number 3, American Express. Buffett's third big investment is American Express. He's been investing in this company since the 1960s. American Express is a credit card company, but not just credit cards, they also offer travelers checks, banking services. Why does Buffett like this company? Because American Express's customers are wealthy. Those who use Amex cards are usually higher income people. They spend more each month, so Amex gets higher commission per transaction. Another reason is American Express's business model is very strong. They charge merchants and they charge cardholders annual fees. They also have a loan portfolio, so multiple sources of income. Buffett believes in American Express's brand value. People want Amex cards because it's a status symbol. This brand value can't be easily created by anyone else. These three companies, Apple, Coca-Cola, American Express, make up over 60% of Buffett's portfolio, and these three companies have made him a billionaire. Now we understand what kind of companies Buffett looks for. Next, we'll learn how we can choose our own 3 stocks. Part 4, how to choose your 3 stocks. Now the most important question, we're ordinary people, not Warren Buffett. How will we choose 3 stocks? How will we know these stocks will do well even after 20 years? Buffett has some criteria that we can follow. Criterion 1, simple business to understand. Buffett says, invest in a business that your grandmother could understand, meaning the simpler the business, the better. Coca-Cola is simple. They make Coke, sell it. Apple isn't simple, but we all use their products. We understand why people buy iPhones. Don't invest in a business you don't understand. Biotech, AI, crypto, if you don't understand these, stay away. Buffett himself stayed away from tech stocks because he didn't understand tech. Even when buying Apple, he saw it as a consumer product, not tech. Criterion 2, competitive advantage. Buffett calls this a moat, like a ditch that separates the company from competitors. Coca-Cola's moat is its brand. American Express's moat is its customers. Apple's moat is its ecosystem. If a company doesn't have something that others can't easily copy, it's not a good company, because after 5 years, maybe 10 new companies will come and take their market. Criterion 3, good management. Even if the company is good, the people running it must be good. Buffett spends a lot of time on the company's management team. He looks at their integrity, their capability, their responsibility toward shareholders. If management is bad, even a good company can be destroyed. So if management isn't good, avoid that company. Criterion 4, long-term potential. Will this company exist for the next 20 years? Will their products be in demand for the next 20 years? Coca-Cola will exist. People won't stop drinking Coke. Apple will exist. People won't stop using iPhones, but many tech companies won't exist after 10 years, so choose companies based on long-term potential. Criterion 5, good price. Even the best company isn't worth buying if it's too expensive. Buffett never buys companies at high prices. He bargains. He says, buy good companies at fair prices. Look at PE ratio, PB ratio. Look at the company's historical value. Is the current price too high? Then wait. Buy when the price drops. If you follow these 5 criteria, you'll be able to choose good companies. And when you choose 3 stocks, make sure they're from different sectors, like 1 tech, 1 consumer, 1 financial. That spreads the risk. Part 5, the 3 sectors to choose from. Now I'll tell you the names of 3 sectors from which you can choose your 3 stocks. Buffett himself likes these sectors because their long-term potential is good. Sector 1, technology. The technology sector has companies like Apple, Microsoft, Google. Although Buffett used to avoid tech, now he's a big investor in Apple because he's understood that tech is no longer just tech, it's become part of our daily lives. You can take 1 stock from the tech sector, but make sure you use the company's product. If you use an iPhone, Apple is a good option for you. If you use Google search, Google is a good option for you. Sector 2, consumer staples. Consumer staples are companies that make our daily necessities, like Coca-Cola, Pepsi, Procter & Gamble, Johnson & Johnson. Whether the economy is good or bad, people will keep buying these things. So this sector is the safest. This is Buffett's favorite sector because companies here are easy to understand and they pay regular dividends. Sector 3, financial. The financial sector includes banks, insurance companies, credit card companies like JP Morgan, Bank of America, American Express, Visa, MasterCard. This is Buffett's second favorite sector because he understands banking and insurance businesses very well. Berkshire Hathaway itself is an insurance company. Be a bit careful before investing in the financial sector. In crises like 2008, this sector suffers the most, but good companies survive long-term. If you take 3 stocks from these 3 sectors, your portfolio will be well diversified. The tech sector will give growth, consumer staples will give stability, and the financial sector will give balance. Part 6. Buffett's warnings. When working with 3 stocks, remember some of Buffett's warnings. Warning 1. This isn't gambling. Working with 3 stocks doesn't mean you'll gamble. You'll research companies, read annual reports, keep track of company news, and be patient. Warning 2. Don't watch stock prices daily. Once you've chosen good companies, no need to watch stock prices daily. Don't sell when prices drop. Buffett says, the stock market is a place where money moves from the impatient to the patient. Be patient. Warning 3. Not all eggs in one basket. Even when working with 3 stocks, don't put all money in one company. Divide among 3 and take companies from different sectors. Then if one does poorly, the other 2 will sustain. Warning 4. Look at share buybacks. When good companies buy back their own shares, it's a good sign. Buffett likes buybacks because it increases his share value. Apple does buybacks every year, which is good for Buffett. Warning 5. Look at dividends. Companies that pay regular dividends and increase dividends every year are good companies. Buffett likes dividends. With dividends, you can buy new shares. The magic of compounding will work. Warren Buffett once said, diversification is protection against ignorance. If you know what you're doing, 3 stocks are enough. In today's video, we learned why 3 stocks are enough to get rich, how to choose those 3 stocks, and which sectors to choose them from. Remember, to get rich in the stock market, you need patience, knowledge, and the ability to make right decisions. Working with 3 stocks allows you to know each company well, and that will make you rich. Do you want to work with 3 stocks? Write, "I'm ready" in the comments. Also, let me know which sector you want to choose your stocks from. If you liked the video, hit like, subscribe to the channel, press the bell icon, and yes, share this video with your friends who also want to get rich by investing like Buffett. That's all for today. Happy investing. Stay healthy, stay happy. Thank you.